Okay, so on this part, what I'm going to do is encourage you to take really good notes. And for each of the 3 groups that we just discussed, we're going to go through 4 different things to them. And so for my video, I'm going to take each one separately, and then I'm going to erase, and we'll just keep those 4 there, and we'll do the next. So if you write small enough, maybe you could get this all on one page and have 3 big columns at the top next to this side stuff. All right, so this group is the property, plant, and equipment, and any finite life intangibles. The asset grouping is the first thing we look at. And basically, we have to see which assets work together. And what we look for is the lowest level of identifiable and independent cash flows. So given that you can provide information on a certain group of assets, maybe they're all used for the same revenue stream. And so they work together. And so if that revenue stream is not doing great, or there's a problem, we might have an impairment that affects the whole group. Okay? Next thing is when to test. So basically, we don't test annually for this group. We don't expect to have impairments on a regular basis. When we do test, there's some events or some circumstances that suggest we might have an impairment. Okay, there's a list of them in your textbook, and there's a list of them in the codification. But let's say you have several years of negative cash flows. You're not bringing in as much as the cost of these assets. There's a change in regulation. There's been damage. There's some event that has happened that has made you say, it's time to take a look at this. So let's say that has happened, and then we're going to move on to how to test. It's a 2-step test, okay? Step 1 is called assess recoverability, okay? And it's a formula. You take the undiscounted future cash flows. And what that means is you've got this, let's say, asset or group of assets, and you're looking at what kind of revenue will they produce in year 1, 2, 3, 4, 5 from here on out. And, you know, at some point it gets more and more subjective, but hopefully with some forecasting, you are able to get some undiscounted cash flows. So you plan ahead and you can say, okay, this is what we think we're going to get over the next 5 to 10 years. All right. So we add all those up together, and then we subtract out the carrying value. Now remember, to get carrying value, you have to take cost minus accumulated depreciation. And those are always kept separate for property, plant, and equipment. It's required by GAAP that we have to report on accumulated depreciation. With our intangibles, you can have an accumulated amortization account, but normally when the information is given, they're giving at its carrying value. So you don't have to do a subtraction to get that number. All right, so what we do is decide whether we have to go on to step 2. If this number is negative, the carrying value is actually bigger than the undiscounted cash flows, then we definitely have a problem, because there's no time value of money here. So if we can't even, ignoring time value of money, we think it's worth less, then we definitely we've got to have something going on. We're going to go on to step 2 before we decide what that impairment is. Okay? So if there's no problem here, if it's positive, no impairment required, nothing done, no step 2. But assuming it's negative, we take this formula here, and we're looking at carrying value. It's the same one. And now we're going to look at fair value. So what's happened, we had this undiscounted cash flows. How are we going to get fair value? We might have to have an appraiser come in, or one of the things you can do is use the time value of money on these undiscounted cash flows, and then just go ahead and find its present value. Okay, the interest rate, if you have to do this, will be given to you. If we have the appraisal, we're going to say the fair value of that is more reliable. If we don't have anything, we'll go with that. We'll do the time value of money and get that discounted cash flow. That amount is going to be equal to our impairment. All right. So our last step of this is, how do we handle the asset going forward? And what's going to happen is that we're going to use the fair value is going to become our new book value. And we're going to either depreciate it or amortize it over the useful life that's remaining. Okay? So that's the walkthrough of that. Now I'm going to put some numbers up and see if it just makes sense. All right, so here's our numerical example. We have a machine, we have the cost, the accumulated depreciation, and we have been given the fair value. We have been given future cash flows for the next 3 years. After 3 years, we think the useful life is pretty much over. So what we do is we apply, we've already been told too that there is cause or concern that there might be impairment. So when to test, we already said yes, we have to. How to test? 2 steps. First step, take the undiscounted future cash flows. And so I just simply added these up, and that came out to $28,000. I subtracted out book value. My book value, cost, minus accumulated, my book value. It came out negative. Since it's negative, I must go on to step 2. So this was assessed recoverability. This is find the impairment. I take my carrying value, it's still $30,000. We subtract out the fair value, and that gives us the amount of the impairment for $9,000. Now in terms of measurement after, the new book value, and we're going to see the journal entry to make this happen, but the new book value is going to be its fair value, $21,000. And what we're going to do is depreciate this over its remaining life, 3 years. So starting next year, after this impairment, then we'll start doing $7,000 a year for depreciation. Our final thing, let's see that entry. Okay, so I've got our information up here, and this is our journal entry. What we're going to do is we're going to debit the accumulated depreciation in total. So when we do that, that accumulated depreciation goes to 0. We're going to debit the impairment loss. That'll show up in the income statement, $9,000. We're going to credit the machine for the combination of those, $79,000. So now let's look what happens with the machine T account. Its original cost was $100. We took off $79. The remaining amount is $21. So starting next year, book value is $21, and we start depreciating it over 3 years. Okay? So that's all there is to it. Just remember, when you do the impairment, you've got to take away that accumulated depreciation. All right, great. We'll go on to the next one shortly.